You're watching Notepad with me, Ibrahim Sani. Spending a week in Singapore actually opened up my eyes in terms of the kind of revelations that are currently happening, economic activity that is currently happening in the region. We want to focus a little bit more on Singapore. This is because Singaporean Prime Minister Lee Hsien Loong did say that the economic challenges impacting that island state is actually going to exacerbate over the next few months and, of course, in the next few years to come. According to the Prime Minister, the inflation issues are going to continue to remain high. Banks are indeed looking at lending more, but at the same time at higher rates, largely because central banks, including that of Singaporean Central Bank, is tightening their policies even further. This is, of course, not an isolated case for Singapore. Central banks around the world is actually tightening policies as well. One area of concern is, of course, well, not concern. One area of interest is, of course, the Central Bank of Malaysia, where we are also expecting a price or interest rate hike in July, although we don't know whether that will remain to be seen. In the region, a recession is going to be impacting many countries between Malaysia, Singapore, as well as Indonesia. And of course, the Singapore Central Bank says that global growth is expected to moderate to 3.9% in 2022 from 5.4% last year. I don't know whether this is an alarming bell for the Singaporean economy or, in that sense, Malaysian economy, but it's important for us to understand what this means for businesses, especially retailers, and of course, retail investors, people like you and me. Joining me on the line from Singapore is Laurent Bertrand, the CEO and co-founder of BetterTradeOff, making his second appearance on the show. Laurent, thank you for speaking to us again. It's been a wonderful time for me in Singapore. I wish I could have caught you in Singapore last week, but unfortunately, our schedules couldn't line up, accordingly. But just a quick, brief into Better Trade-Off. You guys are a Singaporean-based fintech company, and you guys do look at the economic data quite considerably. One area of concern is, of course, recession, whether or not it is going to impact Singaporeans in the long term. Maybe you could share with us whether or not Singaporeans should look at spending, saving, or in fact investing their hard-earned cash. Laurent.
Thanks for having me. Always a pleasure. And I will try to make sure that when I visit KL, we can meet face to face. It
Of
was a
course.
pity not to be able to see you. Look, recession first need to happen. And as mentioned, the global growth is still projected at 3.9%, which is not as good as 5, but not 0 or negative. So we'll have to see if recession hits Singapore or recession hit different country in the region in different ways. What it shows is that we see inflation is eating the portfolio of many people in terms of how much they spend, how much they have to spend. If you have put petrol in your car lately, you probably felt the inflation on that particular item. But I think that if we look before looking long term, we have to look at short term. One of the things before talking about spending, let's talk about income. Um, I think that fear of losing your job might be a factor that influence people's spending and therefore saving, because your saving is your income minus your spending. So if you spend less, you end up saving more. Now, what it means for investments, a different question. But I think for most people, that's going to be a concern, knowing that do I feel secure in my job? Do I feel secure in my business? And if there is a recession, you will see people losing a job. You will see people not having the kind of increase they might expect. And for people who derive their income from small businesses, they might be impacted even more so. So I think that the first part, which is what is going to be the spending pattern of people, and over the short term, we might be seeing spike. Over the long term, let's remember the dynamism of the region, and I do believe that hasn't changed in the near future. But what we can see is that it will have impact for people who are not able to plan before, because they will have to cover their losses that they have done during that period. So if we talk short term, I would expect people to adjust their spending based on what they foresee. That means more saving for some of them. And the question will they invest? And what we see is most people, when they're fearful, are not investing, which is a pity, because the vast majority of people we see in a plan are under protected and under invested. That means they leave a lot of money on the table. Now, needless to say, when you see the stock market going to minus 20%, so bear market, that's a scary thing to do. But that brought us back to what's your plan long term. and what do you do short term to support your plan long term. And I think for a lot of people, if I look at the overall development, what we are not used to is inflation. So we have not gone into any high inflation for a very long time. And if the inflation were to remain high, that's something where we probably open the storybook and see how our parents were dealing with it.
Laurent, I want to ask you a little bit more about how prepared are Singaporeans with this recession impending. Do you feel that more Singaporeans are actually at a vulnerable risk? What about income groups per se? We're looking at higher earners versus middle earners and low earners. Do you think that it's going to impact them differently? If so, how?
I think, as mentioned, the key question for most people is going to be the income, and most people derive their income from their jobs, salaries, or their businesses, depending on the kind of income you have. So you can be high income or low income. If you lose your job, you have no income. So that's the first thing. I think that when you look at the announcement of the Prime Minister and you look at the historical delivery by Singapore government, this is a safe place to be. Let's put it this way: there is a lot of investment for people to find new career, to be always ready for the next development of the economy. And this is something is not new; it has been going on for decades. And the massive effort in investment in people so that they can find the new jobs that are being created, digitalization of the economy, or company participating to it, is one aspect, but it's not the only one. So I think on this one, when I look at readiness, there is a systemic readiness, and in Singapore, I may say it's quite impressive, the consistency and the track record of government on this one. So when it comes to the person in particular, needless to say, if you have no savings, the first thing you need is emergency savings. So you should have roughly at minimum 3 months of expenditures. So if you look at how much you spend per month, multiply it by 3, and that should be what you have ready available so that you can cater for anything unexpected, so you can deal with it and turn around things. So that's the first part. I think in Singapore, what we see from the different kind of people, that's usually not a problem, but it doesn't mean there is no problem. And on this side, high earners are in general in worse condition than many, surprisingly enough, because you earn well, because you have a good job, because you are well educated in general, you might feel that you don't need this kind of emergency. But in reality, every one of us, irrespective your level of income, need that. So that's the first part. The second part is, needless to say, your own education and marketability. And as I said, there's a lot of investment being there. I do believe in Singapore, this is something consistent and very well supported. And the third part is managing your expenses. If you expect that you want to save more, if you want to have a bigger buffer, it is time to look at your expenses. And there, again, it's a question of discipline and ability to manage your expenses well. So that's, I would say, on the cash side of things. The second thing is on the investment. So a lot of people want to get more money, want to be smart and invest well, and they do it through properties, they do it from shares, they can do it from fixed income and bonds. There are many, many avenues available. But when the market is as it is right now, you might wonder, is it the right time to invest? What should I do? And this is, I think, the message for everyone is, when you look at investment, you have to look at two pillars. One, the first one is, why do you do it? And I think the most important is time horizon. And I will repeat it, time horizon, so that make sure that this is not forgotten. By when do you need the money? So if you need the money in 1 year as a down payment for your HDB or your property, you probably don't want to invest it in stocks, because you might lose 30% in 12 months. And I don't think that's such a good idea. On the other side, if you're putting money aside for retirement, and maybe when you're 20, it feels so far away, the beauty of it is you will have the benefits of compounding, and you will also have the benefits as over time assets tend to appreciate. And so that's one reason. The first question people should ask is, by when do I need the money? So that this time horizon is telling you what you should do for investment. But if it's a long time horizon, 10 years, 20 years, 30 years, you should invest, because putting your money in a bank account is not going to yield anything. And inflation, as you've seen, it means your $100 might be worth $93 next year, and even less the year after. So very important to have a time horizon. The second thing is, how much risk do you want to take? And that's something which is really related to your situation as well as stock market. Again, most people think that they can time the market, that they're very clever. I think discipline beats cleverness 9 times out of 10. And if you see professionals, they are very disciplined in the way they invest. And there is a reason for it. It works. So for a lot of people, if you have a long time horizon, diversifying your investment, so not all your money is in one stock. You saw, I think Netflix did minus 25% in one day. So those things happen even for a company like Netflix, which if you look at it, everybody use it. So you might consider it as a good company. But as an investment, if you're only on one investment, you're putting all your eggs in the same basket, not a good idea. So diversification, very important. And second, if you invest on a monthly basis, quarterly basis, yearly basis, or regularly, what you have as a benefit is when the stock market goes down, you buy more. It's cheaper because over time is going to go there. The over time is important because it might take a few years to come back. And at that point of time, if you need the money in 2 or 3 years, that might be too risky. So I think to summarize, for a lot of people, not investing enough. But the first question is, by when do I want the money? I'm investing for retirement. I'm investing for the education of my kids in 15 years. I'm investing for long term. There, I should really take some risk. How much? This is where you have to talk to your professional, the banks, your advisors, but they can guide you in terms of what is appropriate for you, and they can guide you in terms of investment that you should make. So if you look at the situation, recession or not, the question is, if you stop investing, you're not going to make the investment that are going to help you over the long term. And I think this is where my advice is you should consider the time horizon, because recession or not doesn't change the need to invest regularly in a diversified manner.
All right. Time horizon is extremely crucial. Understanding the objective is also important, but not many people know what to look for. To be frank, I guess a lot of investors are panic right now, or in a panic mode, or entering that kind of environment where they are panicking soon. And therefore, it's going to be quite important for us to understand that things must be taken in the long term despite short-term challenges. I will take a short break. When we come back, we'll discuss a little bit more with Laurent Bertrand of BetterTradeOff. We'll be right back after these messages. Thanks for staying on with us. I have with me on the line from Singapore, Laurent Bertrand, the CEO and co-founder of BetterTradeOff. It's a fintech company based out of that island. Laurent, let's talk a little bit more about democratizing the ability for people to get financial tools and financial services. We all know that if you are in the higher income group, the ability for you to have access to better consultants, better advice is actually quite crucial and also quite easy and accessible. However, lower income groups or even middle income group individual might not necessarily have access to these kind of facilities. It is because of this we want to understand a little bit better about how we can democratize financial information to other individuals outside of the higher income group. What would be some of the ideas that you can share with us, the kind of tools that you can share with us for folks that are outside that high income group to get access to better consultants, better advice, better management of tools or financial services so that they can actually make informed choices?
So talking about our friends in Malaysia, Zurich has been implemented our tool. It's My Zurich Life, and you can check our tool that will allow you to test your plan, your financial plan. I think for us, what has driven us from day one is to make, as you mentioned, all the tool techniques and advice available to everyone. And I think for a lot of people, it can be intimidating. Financial planning may be something for the rich, it doesn't apply to us. But in reality, all those kind of information that you have around needs to be put together so it makes sense to you, your situation. So at the end of the day, the situation, if you're high earner or low earner, are still the same. I need to cover my expenses, I have goals, I need to make sure my cash flow is managed, and I need to make sure that when I retire or when I have a goal, I'm able to achieve it. And there, like for everyone else, investing and protection matters. So you're investing so that you put some money and then at the end you get more, but there is a risk. And so the question is, what do I do? This is kind of where the digital solution help you to explore those things by yourself in the comfort of your home, and then maybe trigger the action, which is maybe I should start investing and do it simply what matters in long journey is the first step. So I think that's one thing. If you're in Malaysia, in Singapore, if you're a client of Standard Chartered, there is something called SG Gold Planner. I would invite you to use it. It's free for all clients of Standard Chartered. And this is our solution also available there for everyone so that you can build your plan. And in fact, it takes about 10 minutes total to do your own plan and see what happens. So retirement, protection, property, education, you name it, is really designed to do that. And I think that the power of digital is that with advanced statistical model, advanced machine learning, and all the digitalization, we have made the complex very easy, but without sacrificing in terms of quality. Now, on the other side, a lot of people think it's not for me. I would encourage them to try and see what happens, because for a lot of people, the first step is the most difficult. If you have not invested before, or if you just lost money because the stock market went down, you might feel fearful. But I think that looking at the past, looking at how things have developed, and looking at the future in your plan and how it can help you, I think the right kind of attitude is going to help. And I think for a lot of people, it can be very scary if you don't have a plan. But once you have a plan and you can play with the what if, and I think the what if is so important, then you realize, but I can afford it. Even if things go wrong, I'm still in a better shape than not doing anything. And I think this is one thing we really work hard to, is to help people realize what happens. And for the people who don't feel so confident, or who want advice, then it's so much easier to communicate with financial advisor, because your plan is already there. And so for the advisor, it's much faster and you get a much clearer and transparent answer. So I think our positioning has always been, there is a lot of information right now. It's difficult to understand what is relevant for me. Financial planning has been around, but it has been very complicated and reserved as such to the very wealthy. And what we wanted is to democratize, so people get the right information, understanding, and take action with confidence. Now, the other part is there are more solutions now in the market where you can start investing for $1. There is a lot of opportunities for people to really participate and yet really help democratize the access to investment and protection. And I think on this one, traditional actors has always been, in Asia at least, very driven to make sure that this access continue to be there. Not just a new robot, of course, there are new solutions around. So my view on the market is, it has been difficult to deliver the kind of advice and product at scale, because it was very expensive, because it's very tailored, and therefore only limited to the wealthiest. But with digital now, everybody can benefit from it, including the wealthiest, who have the convenience of doing things in the comfort and privacy of their home. And I'm really looking forward to see this development, not only in Singapore and Malaysia, we also operate, but in Netherlands and other countries where our company has been going.
Okay, Laurent, one more short break. When we come back, we'll conclude our conversation with Better Trade-Off. Welcome back. I have with me on the line Laurent Bertrand, the CEO and co-founder of Singapore FinTech, Better Trade-Off, joining us. Laurent, one thing that I want to explore is, of course, the type of asset classes that people think when they want to invest. A lot of people are talking about the equities and within the equity sector, whether or not stock picks could be an option or just go for an ETF. What would be some of your ideas regarding this notion of ETF versus stock picks?
So stock picking, you need to know what you're doing. Buyers beware. And I think, like, when it comes to investment and long-term investment, it means that you need to have diversification to start with. Okay, that's the first rule. Put all your eggs in one basket, something goes wrong, and then you lose everything. And it has happened many times over. And there are some rules. If you look at the investment side of CPF, you have some limitation in terms of how much you can buy in stock to avoid those kind of situation. Now, so the foundation remain diversify, and then look at your time horizon and look at the kind of risk you can afford. So affordability comes in two ways. How much money can I put aside every month, every quarter, every year? So for my investment. And second, how much risk I can take. If you're investing and in the next 3 years, you need the money, you cannot take as much risk as in the next 30 years, because in that case, market will fluctuate, goes up and down, but fundamentally will go up. Now, the difficulty is not just the theoretical, is the emotional aspect. And I think this is also a part where being able to look at the past, what has been happening. Are there opportunities in single stock? Are there opportunities in terms of properties and other private investment? Yes, there are. You just need to know what you're doing, and you also need to appreciate the kind of risk you have. If you lock your investment for 10 years, it means your money is not going to be out. And it could be if you invest in a startup like us, that means the people who just invest at the start need to wait for a certain time. Of course, they will be rewarded when the company is super successful. But similarly, if you need the money now, you will be in trouble because you're not going to be able to sell the share you have in the company. So that's what's in asset class. There are multiple asset classes. So equity is one of them. Fixed income is another one. Real estate is a third one, right? You can do it either directly or through funds. But there are many other asset classes like private equity and venture capital, hedge fund. But in general, those things are reserved to the wealthiest, and for good reason, because you need to know what you're doing. So there is a large chunk of access. Some of them can be passive, like ETF, and you do have active ETF, by the way, so which make it quite entertaining. But the key question for me is for people to have a clear understanding of the kind of expected return they can have for the expected risk. If it looks too good to be true, it's probably not true, and it's probably quite dangerous. So that's also where talking to advisors and people who are in the market for long term, who have seen the ups and downs, can really help you to calibrate your expectation. After that, it's also a question of education, and you might be able to generate a great return because of your education in investment. And I've seen it done over and over again, so that's totally possible. It's just a question that it takes time. It's not easy, and you're not alone in the market trying to do well. So you should have, for me, the discipline to really invest regularly, diversify the foundation, and then look at other things you might want to do and take the risk that you can afford.
Also, I want to ask you a little bit more about REITs, in particular regarding real estate. Should consumers or investors really think about how they need to diversify their investment in this asset class as well? Think more about REITs, less about property per se.
I think this is really a question of leverage. So when you buy a property, what you have access is leverage because you can borrow and then you can rent it. But there is a lot of expenses, there is a lot of change in regulation and so forth. And liquidity might be an issue, especially when you have a recession. So everybody's losing their job, nobody has money to buy new property. You might have new regulation, interest rate is going up. So which means that the amount of money people are able to spend on a property will go down. And that means fundamentally the price of real estate could go down. So that makes it a bit tricky, even if historically it has been a way for a lot of people to accumulate wealth. So if you don't own your property and you're renting, you will still have to rent you on your old. And that's why the HDB mechanism and all those kind of mechanisms are really good because it helps you to forego the expenses for rental once you have paid your property. Now, as an investment, you have different opportunities, and rate give you the liquidity and give you the leverage already there managed. Now the question is diversification. Should you have one rate? Should you have multiple? I think diversification in general is a good idea. When you have a rate, you already have some diversification because there are multiple properties, but having different rates also means different managers and therefore limiting the risk of having mismanagement and the like. So like everything else, it's really a question of what you can afford and what you want to do.
Okay. Laurent, one final question. Of course, we talked about how investment horizon should be in the long term. However, I really want to talk about the central banks tightening their policy, both in Singapore, Malaysia, and also in the region, as well as globally, to be frank. What will be some of the considerations or the risk factors that you think should be inculcated for investors during this period?
So if you look at the interest going up, your mortgage, if it's flexible, will go up. Okay, so in some countries in Europe, you take a mortgage for 30 years and your interest rate is fixed for the next 30 years. So you're very happy because you're not going to pay a large interest over the next 30 years, while fundamentally every mortgage is going to go up over time. And we have seen this happening already in Singapore, and we'll see that everywhere as it's tightening up. The second thing is the balance sheet of the central bank is expected to contract. So it's not just interest rates. The central bank in the US have mentioned that they will be contracting their balance sheet, which means that they're going to take money out of the market. And the question is, central bank has been buying shares, has been buying bonds. So the impact when you take such a massive buyer out of the equation might not be positive. On the other side, again, the question is, what do you do now in terms of your different elements? So spending-wise, you will see your lending going up. So that's the mortgage side. That's also consumer credit. That's also the cost of borrowing for businesses. That makes things more difficult, but that's the idea, is to reduce the inflation, which would be quite difficult if you look at what happened in the 70s and the rest. So that's the first part. The second part is in terms of investment, banks, for example, are beneficiary of increased interest rate in general. But it doesn't mean that the price will go up. That's the difficulty. This is why diversification investment really helps, because you need to have a broad access to the economy, which over time, remember what you said at the beginning, is going to be 3.9% increase instead of 5. We're not talking negative growth. We're talking still 3.9% increase of the economy over the year. So when we talk about recession, we have to be a bit careful. Central bank coordination is one thing, but every country is going to do what is right for them. And I think we cannot compare the situation of different countries exactly apple to apple, because they are very different situations in terms of the economies.
Yep, great. Understood. Thank you very much, Laurent, for sharing your thoughts and views with us. I would really hold on to your promise that you'll come to the studio the next time you come to KL. Either that or I'm going to Singapore very, very soon again. So maybe we can just talk about that even further. The borders are opening. Domestic travel is international travel is actually quite interesting. I can't wait to get, to travel around the region as well as around the globe as well. It's been a hard 2.5 years. It's important for us to actually really look into how we do our work internationally. But of course, travel is always good. That was Laurent Bertrand, the CEO and co-founder of BetterTradeOff over at Singapore. If you've missed any part of this interview, just head on to astroawani.com, look for Notepad there. You can also look for BetterTradeOff, BTO, or Laurent Bertrand himself on all our sites. Until then, thanks very much for watching and goodbye.